OptionChampion.com.
Today is Friday, August 5th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade on this first Friday in August. Markets were choppy in the Friday session despite a much stronger than expected jobs report. Non-farm payrolls increased 528,000 for the month of July, exceeding the estimate of 258,000. On Thursday, however, new jobless claims rose 6,000 to an adjusted 260,000 for the week ending on July 30th, above the estimate of 259,000. Continuing claims increased by 48,000 to about 1.42 million. As for the markets, the cash indices ended the week mostly higher, with the exception of the Dow finishing the week lower by about 41 2/3. The S&P 500 gained 14, the Nasdaq Composite gained 265, the Russell gained 36, and volatility was nearly flat, coming in by 18 cents on the week. Crude oil ended the week lower by $9.77. Gold gained $9.70. Silver lost 48 cents, and natural gas finished the week lower by 28 cents. Well, I made an earnings trade this week, so in today's episode, we're going to dive into the building blocks of analysis and setting up a trade for a stock that has an upcoming earnings release. And that stock was SBUX. SBUX was expected to report earnings on Tuesday, August 2nd after market close, and all of my analysis was conducted just a few days prior on July 29th. Now, before I break down the analysis, I would like to add that I typically trade options with up to 50 days until expiration, or as close to 50 days as possible anyway. Having around 50 days until the option's expiration allows time for market corrections or adjustments to be made to the position if the trade goes against me. And since options are time-valued instruments, meaning they depreciate as each day passes, having up to 50 days to expiration allows time for that erosion to build before it accelerates as it gets closer to expiration. In the options world, that erosion is called theta decay, the rate at which the option's value decreases each day. And as a trader who primarily sells options for premium, I take advantage of that theta decay by selling an option when the premium is high and buying it back when the premium is low. And 50 days to expiration has worked best for me in this regard. It's not too long and it's not too short. Knowing that SBUX was due to report earnings, I checked out the company's income statement. This was going to be a short-term trade, not a long-term trade, so I was only interested in the recent earnings per share and not the company's balance sheet or cash flow statement. Seeing that SBUX had consistent quarterly profits and a total profit of $3.73 per share over the last 4 consecutive quarters, I decided to go with a bullish outlook on the stock, an expectation that the stock would react positively to the earnings release. Taking a bullish position would mean either buying the stock, buying a call option on the stock, or selling a put option on the stock. Since I like to sell options for premium, I was looking to potentially sell a put option on the stock. With that little bit of fundamental analysis out of the way, I looked at the option premium. Giving the September monthly expiration cycle a quick scan, I saw the strikes were $2.50 wide. meaning the distance between each strike was $2.50, and the premium was decent. I could go with the 75 strike, which was $9.78 below the stock price of $84.78, and sell that put at a premium of $1.40. If I were to sell that 75 put at $1.40 and the position went in my favor, I could potentially close the position early and take maybe half of the premium as profit, which would be 70 cents per share, or $70 for each put option contract. So far, so good. Next is the price analysis. Because I typically trade options with up to 50 days until expiration, all of my historical data analysis is done on a rolling basis over a period of 50 trading days. Over the previous 50 trading days, SBUX had an average net change of $1.19. That means on average over the last 50 days, the stock price increased or decreased up to $1.19 per share. While there might have been a few bigger moves, say $2 or $3 per share, overall the stock had been pretty stable over the previous 50 days. Next, over that same 50-day period, the average price range was $2.20. The price range is simply the daily high and low relative to the previous day's closing price. If, for example, on any given day, the stock decreased as much as 30 cents and increased as much as 70 cents, adding the two together equals $1. So the range would be $1 for that particular day. Next, we have two key pieces of data. The first key piece of data is the maximum price range. Within the 50-day period, there was one day when SBUX stock traded in a range of $3.84. That means the stock price rose or fell by as much as $3.84 per share, when it typically rose or fell up to $1.19 per share. So when choosing a strike, I have to keep in mind that the stock price can move as much as $4 and manage that risk accordingly. The second key piece of data is what I call notable price range. This is where I scan through the historical data and find a maximum price range that's greater than the current maximum price range. Up to this point, I know that SBUX stock traded in a range of $3.84 one day over the last 50 days. But now I want to know if there was a day when the price range was wider than that. Looking through the data, I found that on May 4th, the stock traded in a range of $8.54. So I have a situation to be aware of. Over the last 50 days, SBUX stock had one particular day when it traded in a range of $3.84. But at one point farther back than that, the stock traded in a wider range of $8.54. And that could potentially happen again. Let's assume for a moment that I ignore that wider $8.54 range and just stick with the latest max price range of $3.84. And I sell a put at the 80 strike, which is $4.78 below the stock price of $84.78. And the stock falls $9.78 to $75 per share. If the stock is at $75 and my put strike is at $80, I would be stuck with a losing trade because the stock price would have fallen below the 80 strike of my put option. To protect myself from these situations where the stock could fall farther than expected, I give myself a buffer by selecting a strike based on the wider price range. With all of that analysis, I chose to sell a put at the 75 strike, $9.78 away from the stock price. The put option was in the September 16th expiration cycle with 46 days until expiration, and I received a premium of $1.40 per share. 2 days later, after the earnings release, the stock rose 4%, and I closed the position for 80 cents per share, resulting in a profit of 60 cents per share, or $60 per contract, as each option contract represents 100 shares of stock. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.